Artificial intelligence is not just transforming technology, it is beginning to reshape productivity itself. For decades, economists have searched for the next major productivity breakthrough, a shift large enough to meaningfully accelerate economic growth. Some believe AI may be that shift, but productivity gains are not evenly distributed. And that raises an important question. Who actually benefits from the AI productivity boom? Productivity measures how much output is produced per hour of work. When productivity rises, economies grow faster without requiring more labor. Historically, major productivity surges followed transformative technologies: electricity, the internet, industrial automation. Each wave increased output and reshaped labor markets. AI may represent a similar inflection point. Unlike traditional software, which improves efficiency at the margins, AI can automate cognitive tasks: writing, coding, data analysis, customer service, financial modeling, legal research. These are not minor workflow improvements. They are core economic functions. Early studies suggest workers using AI tools can complete tasks significantly faster than those who do not. In some sectors, productivity improvements of 20 to 40% have been observed in controlled environments. If scaled across industries, the impact could be substantial. But productivity gains do not automatically translate into broad economic benefit. They create value. The question is how that value is distributed. There are three primary beneficiaries of productivity increases: companies, workers, consumers. Companies benefit first. Higher productivity reduces costs per unit of output. Lower costs increase margins. In competitive markets, some gains may be passed to consumers through lower prices. But in concentrated industries, firms may retain much of the benefit. Workers benefit if productivity gains increase wages. Historically, during certain periods, productivity growth aligned with wage growth. But that relationship has weakened in recent decades. In many advanced economies, productivity has risen faster than median wages. AI could reinforce that divergence or help correct it. High-skilled workers who leverage AI tools may see significant boosts. That can translate into higher earnings and greater leverage in the labor market. But workers whose tasks are automated may face wage pressure instead. Consumers benefit when productivity lowers prices or improves service quality. Faster product development, more personalized services, lower transaction costs. These effects can raise living standards indirectly. However, the distribution of benefits depends heavily on market structure, regulation, and capital ownership. And capital ownership is critical. AI infrastructure is capital intensive. The firms that own the models, compute power, and distribution platforms capture early returns. This dynamic resembles past industrial revolutions. During railroad expansion, infrastructure owners accumulated outsized gains. During the oil boom, those controlling extraction dominated. With AI, owners of computational infrastructure and proprietary models may accumulate disproportionate value. Over time, competitive forces may spread benefits more broadly. But in early stages, returns tend to concentrate. This concentration can amplify inequality, if not offset by wage growth or policy adjustments. There is also a global dimension. Nations with advanced AI ecosystems may experience stronger productivity growth than those without it. That can widen international economic gaps. Countries that integrate AI into manufacturing, healthcare, logistics, and finance could accelerate GDP growth. Those that lag may struggle to keep pace. AI-driven productivity could reshape global economic rankings. But productivity alone does not guarantee prosperity. The transition period matters. When automation displaces roles faster than new ones are created, labor markets experience friction. Reskilling takes time. Wage adjustment takes time. Institutional adaptation takes time. If AI adoption outpaces labor market adjustment, short-term disruption may intensify. However, if AI augments rather than replaces workers, productivity gains could enhance job quality. Augmented professionals, lawyers using AI research tools, engineers leveraging coding assistants, doctors supported by diagnostic models, may deliver higher output. This augmentation model could produce shared gains. The trajectory is not predetermined, it depends on corporate strategy. It depends on education systems, it depends on labor policy. In the long run, productivity growth drives economic expansion. Higher productivity supports stronger GDP without increasing working hours. It enables rising living standards. It fuels innovation. AI may be the most significant productivity catalyst of the 21st century. but whether it produces broad prosperity or concentrated gains remains uncertain. The technology itself is neutral. Its economic impact depends on how it is deployed, who controls it, and how societies adapt to it. The AI productivity boom is real. The gains are measurable. The capital is committed. The infrastructure is expanding. Now, the critical question is not whether productivity will rise. It is how its benefits will be shared. And that will define the next chapter of the global economy.